Welcome to the Daily Brief, where I'll go over the action in the market for Monday, March 20th, and then we'll see how things look for Tuesday, March 21st. We had a bit of a bounce. Even though the market is negative, the small caps and the mid caps had become deeply oversold, and so that led a bounce that saw a bit of a recovery. But now we have to ask ourselves, are we starting to shift to a more positive stance, or are we still negative overall? The charts are still negative, but if we see some more follow-through upside buying and a real shift taking place to the market going higher, we have to go with that. But right now, we're just in between, seeing if an adjustment is taking place or if we will resume the downtrend. One bit of housekeeping that I want to take care of is that you notice that I did not publish the supplemental video. What I found is, especially with IsabelNet, when I go back a week, some of those charts just don't apply anymore, and the information changes. So it's not really giving us a lot of insight or information that we're trying to get from these charts. So useful and relevant charts will be merged with other videos. For example, today I have some IsabelNet charts that I'll show you in this video. Other charts may go into the weekly video, the intermarket analysis video, and so forth, because the idea behind that is to give us some insight. Many of the charts are outdated or irrelevant by the time the video is produced, and I found I just didn't like making that video overall. I like making these videos, and I enjoy preparing things and presenting them to you, and some of you have found real value behind that. But when I was getting to the supplemental video, I'm just sitting here thinking, okay, this is not fun, and I don't think it's all that helpful. So it was an idea that I tried out, and now I'm going to go back to what I was doing before. Also, this is well before it's actually happening. From April 22nd through May 11th, I will be traveling. I'm going to spend some time in Germany as well as in Poland. My intentions are to still post at least the daily videos. I don't know about even the daily videos, but I don't know about the weekly videos, the intermarket analysis videos, and so forth. My goal in doing these videos is that I do travel quite a bit, and I like to be able to still do the videos anyway, but there are some things that I can't really control, such as internet connectivity and access to the internet, so I just want to leave that out there in case there is a problem. But this is a month before this trip is even taking place, but I just wanted to warn you ahead of time. And just also be aware that I may not post other videos. If I can, I will. But if I'm not able to do that, to me, the daily videos are the most important videos. All right, let's go back and talk about what happened. Right at the open, we had a higher open with prices going above the daily pivot at 39.26. We also were able to get back above the 200-day simple moving average at 39.36. And also above the daily pivot at 39.30, we even got above R1 at 39.50. As the day went on, prices then retreated down to the daily pivot before rebounding back up to R1. Then prices retreated again down to the 200-day simple moving average before rebounding and then closing above R1. We were up 0.89% on above average volume. It really tapered off from Friday, but that was quadruple witching. But we're still above average overall. The technicals are still negative, and I'll show you lots of charts to back that up because of this inflation and interest rate scenario. We also have the banking situation still heavily in the news, and we don't know what else is going to happen after this or if it has been contained. So here's the intraday chart showing how we had a higher open. Went above the daily pivot. We got above the 200-day simple moving average, all the way up above R1. Then we fell back down to the daily pivot, and then back up above to R1. Then we came down to the 200-day simple moving average and then back up. So it was a pretty choppy day overall. It's just interesting to me how we just sliced through this 200-day simple moving average very quickly, both up and down. Near the end of the day, it actually acted as support before we ended up closing higher. Here's a look at value versus growth. Both were up fairly well in Monday's session, with growth leading the way. And with the large caps, growth outperformed value, as well as with the mid caps and the small caps. Here's an intraday look at the SPY, where we really spiked down right when things opened. That would be Sunday afternoon or evening in the US. The initial reaction was fairly negative, but then we were able to bounce back above that, get up to the unchanged level. The futures then went positive, and then we just took that into the session on Monday. And here's the chopping around that happened, and right now we're just drifting sideways after the market close. What are some comments that we can make? The small caps and mid caps did give some support to the market after being deeply oversold, Banks also rebounded after there was news that came out over the weekend that the Swiss National Bank brokered an acquisition of Credit Suisse by UBS. You probably heard about that, for $3.2 billion. Also, the Federal Reserve announced, along with some other central banks, including the Bank of Canada, the Bank of England, the Bank of Japan, the European Central Bank, and the Swiss National Bank, to enhance the provision of U.S. dollar liquidity while offering assurances that, quote, the capital and liquidity positions of the U.S. banking system are strong and that the U.S. financial system is resilient. Okay, that's what they're saying now. We don't know what's going to happen after this to question this statement, but that's what they're going with right now. They're trying to reignite some confidence in the U.S. banking system after it got hit. First Republic continued to suffer sharp losses, and I have a chart to show you. Its debt was ultimately downgraded as well, which is not a good thing. The Wall Street Journal also came out with an article that Jamie Dimon, who's the CEO of JP Morgan Chase, he's leading talks with executives at other banks about a deal that could involve the previously announced $30 billion in deposits to First Republic Bank. They're suggesting that be converted into a capital infusion, which changes the game a little bit and doesn't look so bad. Mega cap stocks and the NASDAQ and NASDAQ 100 also underperformed. They were the leaders last week while we were running through this banking problem. They took a bit of a breather in Monday's session. Now we're going to have to see. Are they going to come back and lead things higher, or are they going to continue to go down? On an intermediate term basis, we still have the BPI that's extreme negative. The dollar was down and interest rates were up. We still have the 30 to the 5 that's being normal again, but all of our other yield curves are still inverted. Sentiment is negative. It actually ticked up a bit with the up day. It had been at 24, where after Monday it was at 29. Our trend is negative and it's weakening. We're dropping below the moving average. So the ADX is going down. We're also below 20, so that's suggesting we're not in a trending environment. Our bias is now mixed. Even with the update, we have this negative backdrop. So I've just decided to keep it at mixed, where our momentum is still negative. Now we have another good up day, and that could switch over to positive. We didn't have any economic reports that came out in Monday's session. Here are some of the Isabel Net charts showing how buybacks that corporations are going into and buying their own stock, that's really dropping off right now. Typically in a healthier environment, you'll see the buybacks going up. Well, this could be a warning sign. How much cash do the banks actually have on hand? This chart suggests that the U.S. banks have plenty of cash on hand and that most banks are in very good shape. The problem that I see from this chart is look when this is dated. This is January 2019. This is before COVID. This is before the problem right now. But it's just suggesting that the banks could handle depositors coming in and asking for their money back. But this information is over 4 years old now, so it can't be all that helpful. Also, this chart suggests that the equity risk premium appears to be finally adjusting for the earnings risk we see. The little note here says that if a U.S. recession occurs this year, the equity risk premium should rise materially. It's been going down and it's starting to go back up. If we see this going up, that just means that there's more risk in the market, which could be a problem. But we still are in this high risk zone. We're not seeing a real equity capitulation yet. If you take all of the stocks globally, we're seeing flows still staying at pretty high levels. We're coming down just a little bit, but we're not seeing a real sharp decline like we've seen in the past. This chart says that over the past 2 decades, stocks tend to bottom in March. That's the yellow area here. We're just waiting to see if that will happen. This is a chart that's a little varied from the chart that I showed in the weekly video. This is called the Smooth U.S. Recessions Probabilities Chart. This green arrow shows where we're at right now. We're not even above the black line. When we really get concerned is when we start to go above the red line, and we're far away from that. The problem with some of this data is it takes a long time to get to us, so things may already be well underway before we actually see it confirmed in some of these charts. This chart looks at the lending standards, and it says they've never been this tight without a recession. As we're going down, if we cross below this dashed line, that just means that standards are getting even tighter because their willingness to lend is dropping off. When we drop below this, chances are we will go into a recession. Then a quick update with where is the Fed at right now. Back on March 3rd, we were looking at a 25 basis point hike. Then after Fed Chair Powell came out, we were looking at a 50 basis point hike. Now we're back to a 76% chance that the Fed will raise rates 25 basis points on Wednesday. The Ulster Index is still a little bit above the moving average, showing that there's an increase in fear. With the up day, the VIX declined on the line chart as well as on the bar chart, but the VIX is still relatively elevated, and the VIX of the VIX shows that volatility is starting to go down slightly as we were going back up, but this is still pretty high. The equity put call ratio, after giving us a spike above 0.8, is now starting to come back down. Quite often that will mark a bottom in the S&P. We're waiting to see if that will happen. Looking at another fear gauge, we're still going up overall as far as fear, but we didn't see much of a tick up in Monday's session. Our trend is still below 20 with the ADX, and we're dropping below the moving average, so that just suggests we are trendless. The red line is still on top, although it is declining, but so is the green line. The daily chart is showing that we're still above this downward sloping trend line, and we're just a little bit above the 200-day simple moving average. On the bottom, you see where volume dropped off quite a bit, but it's still above average. And here's a 2-year look at that same chart, where we're still maintaining this level above that trend line. No real change in the Arun indicator. It was flat from Friday to Monday after coming off an extreme negative reading. It's still negative overall. Our stochastics showing a little bit of improvement in the short term, also some improvement but still negative in the intermediate term, and turning up after being extreme negative in the long term. And we're coming right back up to the midpoint of our standard deviation chart. We had been all the way down to a -3 standard deviations before bouncing back up, so this is suggesting the markets are currently at equilibrium. We're also seeing the 20-period moving average act as overhead resistance, as is the 100-period moving average, especially the simple moving average. That's the green line. If we can break up above that and then break above the 20-period moving averages, that would improve things quite a bit. And our moving average tree is also showing how we're coming up to the underside of most of the moving averages, but we are above the 200-day simple moving average. This is positive. The Swinland Trading Oscillator based on price and volume are advancing and starting to go above zero. We're seeing some improvement with our oscillators. The slope has been up for a few days now. We're seeing the TSI turn up. The MACD, the PMO, and the PPO are showing some improvement, but they haven't quite crossed positive yet. Where our longer-term oscillators, the TRIX and the KST, continue to decline. Parabolic SAR is still negative with the dots on top. Chaikin Oscillator, this is positive. We're above the zero line and advancing. The PMO study, after giving us an extreme negative reading, the percent of PMOs are starting to show some improvement. We're no longer extreme negative with the buy signals, but we're still declining with the PMOs that are above zero. The BPI still is the only indicator that we plot that is extreme negative. It ticked up just a little bit, but it's still below 30. The NYSE bullish percent index ticked up also, but is still in an overall decline. Chaikin money flow showing some improvement, but still negative. Balance of power above the dashed line, so this is turning more positive. TTM squeeze also showing some improvement, but still negative. The go, no-go is still neutral. We're still above this anchored moving average going back to the COVID low. That is providing some support if we continue to fall. If we start to go higher, we're looking at resistance going back to the all-time high at this anchored moving average at about the 40.76 level. We are slightly above the 200-day simple moving average. It's like a teeter-totter going above and below the 200-day simple moving average. Our short-term fib chart still has us holding support. At this level, we might hit some resistance at about the 4,000 to 4,004 level. Our longer-term fib level shows that we have some resistance also at about the 4,000 level. And our long-term fib shows that we're in no man's land. If we really go up, we have resistance at 40.20, or we might have support at the 38.26 level. Our really long-term look at this shows that we have additional support at the 38.09 level, and we're still above the 200-week moving average. The Elder Impulse system for the S&P has switched back to positive with a green bar. The McClellan Oscillator showing some improvement, but is still negative. And our wider-based McClellan Oscillator is also showing some improvement, but is still negative. The summation index based on price and volume continue to decline, so that's negative. The new highs, new lows continue to decline with our 5-period and 10-period moving averages. Showing a little bit of improvement with the advanced decline line, but we're still below the moving average, and we didn't see quite as much of an uptick based on volume. Our advanced decline ratio is still below zero, although showing some improvement, so that's negative. Accumulation distribution is positive. We're above the moving average and advancing. Volume ticked down just a little bit from Friday's session. Here's the ratio between the financial sector and the S&P, showing how it ticked up a little bit, but is still showing some massive weakness. Here's the bank ETF. It was up 1.59% after really going down last week. Here's the regional bank ETF, also up over 2%. And another regional banking ETF was up over 1%. Here's the ratio between the regional banking sector and the financial sector. Still not showing that much of an improvement. And here's the First Republic Bank, where it had been at 115. Then after Friday, it was down around the mid-20s. It got cut in half again, and we're currently down at 12. The Dow is still below the 50 and 200-day moving averages. That's negative, but positive, we're still above this support level. The diamonds continue to be neutral. The NASDAQ is giving us a recent golden cross. We're coming up to this pivot level, which may be acting as resistance. The NASDAQ 100 also could have some overhead resistance after giving us a recent golden cross. The Qs remain positive with green bars with the Elder Impulse system. The small caps bounced up a little bit. It's hard to see because of this volume bar here, but they did improve 1.33% on Monday. Here's another look at the small caps where this support level has been holding so far. So if we drop back down, we'll be watching this level. The RSI, which had been extreme negative, is starting to show some improvement. However, the MACD continues to decline. The small caps have switched back to neutral with the Elder Impulse system. And the small cap ratio continues to break down against the S&P 500. The mid caps also bounced up 1.67%. But they're still below the 50 and 200-day moving averages. The Elder Impulse system for the mid-caps has switched back to neutral. And the home builders, where we're seeing a decline in the S&P, the home builders have also been declining but bounced a little bit in Monday's session. The relationship is starting to get stronger, so they're actually confirming each other. The Copic curve is trying to give us a buy signal. The stock-to-bond correlation is still pretty strong, but starting to wear down a little bit with them going in opposite directions. Bond yields are now bouncing around the 3.5% to just under 3.4%. And bonds, after really going up last week, are now starting to go a bit sideways. The RSI is still positive above 50, and the MACD shows that the momentum is still positive. We're seeing fear ticking up a little bit with this other chart, although it did tick down slightly in Monday's session. Looking at the long term, we're still watching this MACD. It's right on top of the moving average now, so it's pretty indecisive. What we're trying to determine here is we broke out above this downward sloping trend line, but the MACD, which had been looking good when that happened, is now starting to roll over. And if this continues to decline, if we lose this downward sloping trend line, that may suggest that this is a fake out instead of a breakout. An update of our possible positive scenarios. With our 19-day exponential moving average of the advanced decline ratio, after getting extreme negative, we're bouncing based on price and volume. That could be a positive backdrop for the market. We're seeing a little bit of weakness with our ratios between growth and value, where it ticked down slightly with the Qs, but they still have been doing quite well compared to the S&P. Saw a little bit more weakness with discretionary to the S&P, where large cap growth against large cap value ticked down slightly, but it has been strong lately. We're seeing pretty much the same thing with our growth to value ratios. The large caps down a little bit, the mid caps and the small caps, but still really outperforming the rest of the market. And that could be another positive backdrop for the market. This is a concern where we're seeing our 50-period exponential moving average of the new highs minus the new lows starting to go negative. And here's the indicator that still is below zero. So that's just adding to this moving average being negative. Also, the 2-year yield, after really spiking up, has been coming back down. We'll have to see. Will this be able to give some more support to the S&P 500? We're still working off of this high spike with our staples, the S&P 500 ratio. Even though this is coming back up, it did decline a little bit in Monday's session. What we're watching for here is to see if this ratio continues to go up and actually take out this spike. It doesn't look like it's doing that yet, but we want to watch this each day. What's our outlook for Tuesday? The FOMC will make their big announcement on Wednesday at 2 p.m. Eastern. The technicals are still negative overall. That hasn't changed. We have existing home sales coming out. And then the whole list of geopolitical events. The markets are still really fixated on this banking problem, but also the inflation and interest rate scenario, wondering what the Fed is going to do. Everybody seems to have an opinion. We have to wait and see what actually happens. The Stock Traders Almanac statistics are pretty negative for Tuesday's session. We're only up 33.33% of the time with the Dow. The S&P's down even worse at 28.6% of the time being positive. The Nasdaq is also negative, being up 42.9% of the time. Then these other areas that are supposed to be providing a positive backdrop, but we're just not seeing that yet based on price. We need more than one update and a real shift in all of our indicators to confirm that. We're coming into the 15th trading day of the month. Even though it's negative historically, we are positive looking at this dashed green line where we tend to see upward movement when we're in a pre-election cycle. We're also coming into that part of the year when we should be seeing a real improvement in March, which also shows this sweet spot that we're supposed to be in right now, but we'll have to see a lot of follow through first. So our scenarios, you could go with the down one, but please be advised we are not trending, and it wouldn't take much to kick this market into an oversold condition, which may produce a bounce. But the technicals are still negative overall. You can't really go with the up one because we're not really seeing any confirmation yet that things are improving. There are some positive backdrop things. There's some things that we could look to, but until we see follow through based on price, we just have to treat them as potential positive backdrops. So we're still going with the sideways trend because the ADX is weakening. It's below the moving average. It's also below 20. The red line's on top, so it is negative. Our conclusion, the S&P is still negative. This hasn't changed after Friday's session. Short and intermediate term, we're negative. Long term, we're dancing around. You could switch this back to positive, but who knows? We could go back below this pretty quickly. We're right around the 200-day simple moving average now, so who knows what we're going to be like after Tuesday's session. Thank you. I hope you found this helpful. I hope you like the adjustments that I'm making to this. If you have any feedback, please feel free to put a comment below, or you can always send me an email. I have my email address right here. I hope you have a very good day, and I will talk to you in the next video.